Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Chicago soybeans. Okay, so once again, a quick look at my longer term monthly charts. As I highlighted 13 weeks ago, there had been some very interesting actions taking place here. So the market, since as far back as the low seen in August 2024 till October 2025, built a sideways action. I noticed this action 53 weeks ago, so over a year ago, and I'll expand on that part shortly. But I just wished you to see that this sideways action had a breach on the upside in October last year, and a second more serious breach in January this year, with February's bullish closing long white Mariposa pattern making the highest monthly close since May 2024. And what is more, a close over the declining mauve 3-year moving average, currently 11.45 and 3/4, which had capped the rise back in November last year. I had previously cautioned about the possibility of a longer term false break on the upside, but with the close over the 3-year moving average and now a further move higher in March, pushing over the bright red neckline, currently 12.14 and 3/4, that warning is now removed, and must now look at what will be next. For starters, this now removes the previously laid downside targets and the major long-term pattern here on this monthly chart, the 2020 to 2024 very large head and shoulders top pattern type. The strain on these had been they've been too much for some time, but I had been holding off retiring them until this month with the move above the bright red neckline, even though we have not as yet closed over it. The move up had been enough. This now maintains the bright red neckline above in the frame, along now with the starting to decline 5-year moving average, which is currently 12.70 and 1/4. Back now to my daily charts, and you can see that same bright red neckline above the current market, pierced but not as yet broken. So the recent action had been a small bull channel formed over February, with prices that shot up at the start of March through the bright red neckline, but even more swiftly turned back down, though they have been stopped by the extension of the same small blue bull channel's lower channel line, highlighted in pink on my daily chart. It's actually basically just an uptrend, and that's currently 161.5. And it's an interesting development. Just left behind what could be seen as either a possible double top or V top. In either situation, the market has not followed through with this pattern, not yet at least. So why did the market shoot higher, and then why did it stop and revert back down? The opportunity of a break higher or lower were there, and the market chose higher, which is fair enough as the top side targets for such a move were reached. I said as much 2 weeks ago when I said, and I quote, "So late last week prices pushed up over the November 25 high, 11.72.5, and have tried establishing over this level. However, though we have spent time over 11.72.5, we still as yet have not closed over it. This must be the first order of business, consecutive closes over it, if the bullish incentive is to be maintained." End of quote. It seems that this very level, 11.72.5, with consecutive closes, was indeed the trigger for the setting off the market higher. I also added 2 weeks ago, and it's an interesting point, and I quote, "Now it may just be me, but if you were going to punch through those two seemingly major resistances, then it would seem a good time to do it is when they're close together, and that is what will happen when they cross in about 2 weeks. So it'll be interesting to see if they combine to cap prices or else are taken apart together." End of quote. This of course refers to the bright red neckline and to the dark blue middle tone, which helps explain the next bit. So why did we stop and head back down? Well, that is a many-fold answer. The things that stopped the rise can be listed as follows. Obviously the bright red neckline. Then the dark blue middle time, currently 12.14 and 3/4 also, of the December 24 to August 25 bullish Andrews pitchfork. And finally the 50% Fibonacci line of the April 20 to August 24 move at 12.22. To a lesser degree, the market approaching the purple neckline extension, currently 12.63 1/4, of the small late October to early December head and shoulders top, and the bright green neckline extension, the small October to November 2024 head and shoulders top, may also have helped. The first one was from 2025, of course. So what now? Well, it seems we are still on the bullish path here, with the bright pink uptrend below, but we still have an awful lot of resistance to overcome, especially once we reach the bright red neckline. So it would seem that that is where the market right now wishes to go. Chicago soybean meal. The market halted its autumn decline just under the gold flatlining long moving average, currently 295.40, down at the congestion at 290.80, which is within the big old April to August 2020 congestion between 282 even to 300 even. I said about this congestion 13 weeks ago, and I quote, "Is this enough to hold it? I'm not sure, but it's enough to make the market think about holding." End of quote. This whole December 25 to January 26 move down left us with both an interesting bear channel and a descending expanding wedge pattern. Prices broke up and out of both ideas, halting for a while at the significant dark blue trendline extension, currently 312.60 of the July to September 2021 descending triangle. 6 weeks ago we saw a drop down for some fresh ammunition before turning back up. The move higher reached the primary, secondary, even the tertiary targets topside. Prices then started stabilizing over more specifically the rising mauve medium moving average, currently 309.80. An excellent example being seen on Tuesday this week, but I have in the past run into trouble with the combination of the 50% Fibonacci line of the May 24 to July 25 move at 326.20 and the bright red middle time, currently 330.60 of the bright red late September 25 to mid-January 26 bullish shift pitchfork. I cannot express any further just how important that was, especially today when we peaked at that bright red middle time. Well, since that first time back in late February, the bright red middle time has advanced higher, such that today prices are testing again. Well, they tested the 50% Fibonacci line on its own and possibly set up to make this week a weekly key reversal up. Well, we're pretty close to it. So if we close tomorrow night either over 322.70 or under 317.20, then we'll be on. Anything in between will have a lesser outside weak pattern. Right now we're looking at a weekly key reversal up, and that is a bit of an understatement. So if we do start closing over the 50% Fibonacci line, and we're still doing this at the moment, then the next choice will be the bright red middle time. But a word of caution, see, that is now awfully close to the 2025 high at 333.50, and they together may be a stronger resistance than each individually. However, if you are going to break those resistances, what better way than to do both at the same time and save the effort of having to do one later than the other. Finally, a word of caution. This commentary, and I'm sorry if you feel this way, but still a word of caution. This commentary would not be complete without my discussing a portion of my commentary which I had repeated for 145 weeks, so coming up to 3 years now. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, "And I only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and have been living in the shadow of this pattern ever since." End of quote. I have also added ever since, and I quote, "There's only one thing you take away from any of my musings, let have been those words." End of quote. For nearly 3 years, the shadow of that pattern has darkened the skyline of this market ever since. Chicago soybean oil. There are 3 patterns here that have defied the move up this year. One is no longer working, and one is no longer working but is still showing some market influence, and one is still driving, is the driver of this market higher. The one that's primarily driven prices higher throughout February but is no longer working is the February based and quite acute dark blue bull channel. The pattern that is the current driver of this market is the bright pink March to August 2025 bullish Andrews pitchfork. The bright pink upper time, currently at 70.63, capping the market at the start of last week. Then there is a pattern that was breached, then broken, but which is still showing some influence even now. And that is the broken on the upside bright green bullish shift pitchfork, for the same move as the bullish Andrews pitchfork. This was breached and broken 2 weeks ago. But this week, the upper time, currently at 63.36, caught the falling knife and held up prices on both Monday and Tuesday. As any of you who follow my words will know, such a thing happening of the market crawling along the top of a broken pitchfork is not unusual. This just happened to be a really good example of one. Thus, we now also sit on top of that on some congestion seen between July to August 2023 between approximately 62.50 to 65 even. So where now? Well, I'm looking to see if prices can stabilize over the bright green broken upper time, but I can already see another hurdle ahead, not above but ahead. You see, the broken bright green upper time crosses the bright pink middle time around the 8th of May, and that would be a likely point to see some volatility. The only feature that might offset this is that we now have a broken bright green upper time, not a completely intact one. But the market may not let that put it off, so caution as we approach that date.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.